Right, so we want to look at cost profit volume analysis. Right, so you should know cost profit volume analysis is a very popular topic. So if it is part of your syllabus, chances are very high you get a question with decent marks on this particular topic. It's very, very important to the syllabus. Right, it is also one of the topics that you will also find in other topics. So the principles that you cover here in cost profit volume analysis will carry you in other topics as well. So it's just like the direct and indirect, you will see here that we are very much applying the direct method of an income statement when doing cost profit volume analysis. So in that manner, cost profit volume analysis will also affect you in other topics there. Right, so when you talk about cost profit volume analysis here, right, these are techniques, right, these are techniques used by management, right, these are techniques used by management, right, to estimate the impact on profit, right, to estimate the impact on profits, right, of changes in the following. Right, so we are simply saying these items that we're listing here, right, they determine the amount of profitability that a company can attain. Right, so we've got quantity, right, or output, right, in other words, units sold. Right, so obviously that will affect profits. Usually, if you are dealing with a profitable product, the more units that you sell, right, the higher profit that you can make. Right, then we have also the selling price. Right, we also have variable costs. Right, usually measured per unit here. Right, and then we have what we call the fixed costs. Right, the fixed costs here are usually measured per total. In total. Right, so cost profit volume analysis basically analyzes these four items that we've listed. Right, and then using our analysis of the behaviors of these four items, we are then able to predict the impact or the amount of profit that a company can get if there are changes in any of these variables. Right, so just to add interest to what we're doing, at the end of the day, we are saying profit, right, is equals to, right, total sales minus total costs. Right? And then obviously sales is a byproduct of the quantity sold multiplied by the selling price. So we get our total sales. And then the total cost, remember, can be broken into total variable costs, right, plus the total fixed costs. Right, we can continue and symbolize that and say usually quantity is represented by XP all right, so that it doesn't make we don't make a mistake or we don't confuse. Let's start with the price. So it's the price multiplied by the quantity. So normally we represent P for price and X for quantity is equals to, right? The total variable cost can be broken down also into, right, quantity, right, which is X and P variable cost. So let me just say variable costs, right, per unit multiplied by a quantity. So that gives me my total variable cost and then less total fixed costs. Right, so I've just broken the variable cost here. Right, I've just broken the variable cost here. Right, and given you that in bracket is your total variable cost per unit multiplied by the quantity. Right, so we can continue and symbolize and say Px here. Remember, the P is for price, X is for quantity, minus variable cost is symbolized in this particular type of calculation by B. Right, X representing what? Quantity, and then we say fixed cost. Right, the total fixed cost is represented by A. Right, so therefore we are saying net profit is equals to Px minus Px minus A. Right, we can continue and say if you take the price or the selling price, total selling price, we subtract the variable cost, and then we can come to the conclusion also that net profit is equals to contribution, right, minus A. Right, remember, selling price minus the variable cost gives you contribution. So ultimately, we're saying net profit is equal to contribution minus the fixed cost.
Oh, 也是有
Right, please mute, thank you. Right, so we can clearly
也
see,
非常其实
please mute, thank you. Okay, thank you. Right, so we can clearly see that profitability of the company is simply determined by these four items here. Right, it is a byproduct of the quantity sold, which is the X, byproduct of the selling price, which is P, byproduct of the variable costs, byproduct of
And then also don't forget to blend
right.
food water energy.
Yeah, my God. Right, so when we talk about the cost profit volume analysis, these are techniques that can be used to estimate the impact on profitability if there are changes in any of these given variables. Right. Common calculations. Right. Common calculations in CPV analysis. Right. So when you deal with the cost profit volume analysis calculation, right, you need to know how to calculate contribution per unit. Right, so contribution per unit is very important, which we calculate by saying either total contribution, right, total contribution divided by output of total quantity. Right, remember we're talking about quantity sold, then we'll be able to get that. So this is one method, right? Or we can simply calculate this contribution per unit by simply saying selling price per unit less variable cost, right, per unit. So this is one of the most popular calculations, obviously, when it comes to management accounting, the calculation of contribution, right? You will deal with that a lot in many different topics, right? That's contribution per unit, very crucial to our understanding of cost profit volume analysis, right? We also get what is called contribution per unit. Sorry, contribution ratio. Right, the contribution ratio. Right, so when it comes to the contribution ratio, right, it's your contribution, which is sales minus variable costs, right, divided by sales. Right, all of that multiplied by 100/1, and then this is given out as a percentage. So that's your contribution ratio. Right, so obviously when we look at contribution, Right, remember contribution. Right, contribution, right, is used, right, to recover or to cover total fixed costs, right, and contribute to profit. Right, so in other words, if your contribution, right, exceeds fixed costs, right, it means as an entity, you will be able to attain a profit. And if your contribution is below the fixed cost, it simply means you are going to make a loss. So this is what we have. Remember, at the end of the day, for you to calculate net profit, you have to say contribution minus the fixed cost. Then you can determine the amount of profit that you can make. Right, that's contribution. It is used to cover the fixed cost, and any residual amount after the fixed cost have been covered, it means you made a profit. Right, then we have break-even. Right, we have the break-even calculation. Right, what is the break-even, good people? Right, what is break-even? Right, this is the level of operation, right, or sales, right, that results in neither a profit or a loss. Right, in other words, at break-even, right, profit, right, equals to zero. So you are making neither a profit nor a loss. You are simply at equilibrium, right, when you attain break-even. Right, another way of representing break-even could be to say it's at, right, a level, right, it's at a level, right, where contribution is equal to fixed costs. Right, so remember at break-even, we are saying, right, remember the calculation of net profit is equal to contribution, right, minus fixed costs, which means if I'm going to be having zero there, right, if I'm having 1,000 there, then I must have 1,000 there, right, so that at the end of the day, my net profit will be zero. So therefore, at a level of break-even, we are simply saying, right, the value of the contribution is exactly equivalent to the value of the fixed cost, giving us a profit of zero. Now, break-even is important to a company, especially when the company is planning on production. Okay, right. So when a company is busy planning on production, right, it does help for management to have break-even. Let's say that we are working on an output level based on our relevant range, right, of 50,000. This is what we plan to produce and sell. Right, if our break-even maybe is at 15,000 units here, right, these are output in terms of units. So if this here represents break-even, right, remember what that actually entails. Right, it means that at this level, we are going to be making losses. Right, at this level, we are going to be making profits. Right, but here we make zero profit. So at break-even, we are exactly at equilibrium where we are making neither a profit nor a loss. Right, any production that is below the break-even quantity of 15,000 will mean that the entity is making losses. And as we produce less units towards the zero, the bigger will be the loss. So the loss grows as we approach zero. Right. At the same time, any production over and above 15,000 will simply mean that we are making a profit, and the further away from 15,000 towards the 50,000, the higher the amount of profit that we can make as an organization. Right, so this is a representation of break-even. So to someone who is sitting down and planning production for a company, it is a crucial information to have to know the break-even level. It will tell you that as you are planning your production, you cannot possibly exist as a company if you produce below 15,000, because you start making losses and you probably not make it. Right, but any production above, the 15,000 level, right, it simply means the company can at least survive as an entity. So that's a good figure to have when you are sitting down and planning your operations for a particular year. Right, so that is break even. And then in terms of calculations, right, sometimes we calculate break even in terms of units. Right, sometimes we calculate break even in terms of units. So you need a formula for break-even units. Right, so what I'll give you are the formulas for single units. Right, so this is an entity that produces a single product. Right, so what is the formula, good people, for break-even? What is our formula? The gas is very quiet. Anyway, it's our total fixed cost for a period. Right, it's our total fixed cost for a particular period. Right, all of that divided by the quantity, by the contribution per unit there. Right, so divided by contribution per unit. Right, then you get break-even units. Sometimes a question may require for break-even, right, in value. So when we say break-even in value, we're saying how much should you sell in rand value for you to break even. Right, break-even units, how many units must you sell to break even? So the formula is similar, it's still your total fixed cost for a period. Right, total fixed costs for a period, right, this time divided by the contribution ratio. Right, so this time divided by the contribution ratio. Right, if you already have the
Sorry,
contribution.
can I ask something? Can I ask question? I'm sorry.
Okay.
So actually, can you please explain a bit of what is contribution ratio? So it can.
The contribution ratio is an expression of contribution as a percentage of sales. So this is the formula that we have. Right, so this is the expression of contribution as a percentage of sales. So we are saying if you sell for 100 Rand, right, how much of that 100 Rand represents contribution, which is your sales minus your variable costs. That's what it means. Ne? So it's just an expression of contribution as a percentage of sales. Right, hope it makes sense.
Okay, thank you.
Sharp, sharp. Right, so once we have that, we are saying sometimes you already have maybe your break-even in terms of units, and you want the break-even ratio. So this time you just say break-even units multiplied by the selling price. Right, it should give you a similar calculation. Right, so those are your calculations in terms of break-even. Remember, I'm just giving you formulas and the popular calculations that you calculate. Right, we also have what is called margin of safety. Right, so when we talk about the margin of safety, right, this captures the quantity right? Or, right, let me say quantity, let me not use ratio. This captures the quantity by which sales can fall, right, from expected sales, right, before a break even or before a loss can be incurred. Right, so remember the calculations in cost profit volume analysis are dependent on what we call the relevant range, right, which here in my example is from 0 to 50,000. Now, when we say the relevant range, we are saying this is the quantity up to the maximum where we understand cost behavior. And we understand cost behavior because we normally operate within that particular range. So let's say as an entity, you have a production capacity of 50,000, right? And you have worked around that 50,000 quantity before. Maybe you produced 50,000 before, you produced 40,000 before, but you always work around up to a maximum of 50,000. So you're saying through observation over the years, you now understand how your cost will behave from 0 to 50,000 because that's a range which you have worked in before. Right. However, if you exceed the quantity of 50,000, you do not know how cost will behave. It's an unknown area that is over and above 50,000. So your relevant range is actually 50,000. So this here is called expected sales. This is your expected sales quantity. So that therefore we are saying, right, remember this particular area here from the break-even up to the expected sales will represent profitability. But anything below the break-even will represent a loss. So we are saying the company is safe as long as it operates within this particular space. Okay, right. It is safe from incurring losses because once you start incurring losses as an entity, right, chances of success are actually out. Right. So that therefore we are saying by how many units are we safe by? Right. We are actually safe by quantity of expected sales, right, less break-even sales. So in my example, if I said 50,000 and I said break-even is 15,000, then we are saying margin of safety is actually 35,000. Is it 35? Right, that's 35,000. That's our margin of safety. So we are saying we can have sales dropping by 35,000, at least the entity will be able to survive because we'll make neither a profit nor a loss. Right, we'll be able to survive maybe for 1 or 2 years, and then we can try and put a remedial action to improve so that we get profit. But if your sales drop above 35,000, then you are immediately under pressure as an entity because you'll be making losses and the company will not be able to what? To survive. Right. Are we clear on what margin of safety is? Because you can get a theoretical question that says, in your own words, explain what you understand by the term margin of safety, 5 marks or 4 marks. You should be able to explain that. Any question? Right. The margin of safety can also be expressed in the form of a ratio. Right. Most questions ask for the margin of safety ratio, not just the margin of safety. So you should be clear also about the ratio. Now, when we talk about the margin of safety ratio, basically we are saying this is the percentage, right, by which expected sales, right, can fall by, right, before a loss, right, before losses right? It's basically a expression of the margin of safety as a ratio, right? Remember here, if they say calculate margin of safety, they are saying how many units. We say 35. But if they say ratio now, they want in percentage form. So you calculate the margin of safety as indicated above, right? And then you divide that, right, by the expected sales, right? All of that, then you multiply by 100 over 1. Then you get a percentage. So in our example, we'll obviously say 35,000, which is the break-even, sorry, which is the margin of safety, right, divided by expected sales of 50,000, all of that multiplied by 100 over 1, then we'll get our figure. So it'll be 35 divided by 50, that will give you 70%. So that we are saying sales can fall by 70% from the expected sales quantity of 50,000, right, before the company encounters a loss. Right, one more important calculation, right, a number of units, right, to achieve, right, a target profit. So we can use cost profit volume analysis, right, to determine within the relevant range how many units we need to actually sell in order to achieve a target profit. Right, so what you do with this one is similar to break even. You simply take your total fixed cost for a period. Right, then you add your target profit. Right, for that period, and then you divide that, right, by contribution per unit. Right, so that should give you, right, your units that you need. Right, sometimes it can be a value or sales value, right, to achieve, right, a target profit. Right, so if that is the case, right, you know what to do when you're looking for value. You simply divide by the contribution ratio instead of the contribution per unit. So it will be your total fixed cost for a period, right, plus the target profit. But this time, because we want value, right, then we'll divide by the contribution ratio. Right, or if you already have the number of units, right, to achieve a target profit, you simply multiply by the selling price. Right, again, it will give you the same answer as long as your calculation of the number of units is correct. Just multiply that by the selling price, and you'll be able to calculate your number or your sales value to achieve a certain amount of break-even. So you'll be calculating in rand value this time. Right, so what I've explained to you is your break-even calculations and formulas, right, for a single unit, for a company that is producing only one type of product. So obviously, the calculation will then be adjusted a little bit when we have multiple products. So next we'll do the multiple products, but first things first, let's do a small question on a single product. At this level, most of your questions will actually be on multiple products. All right, so we are just recapping on a single product. All right, so I did send a question on the group with or a document with these questions, so you can actually view it from the group there. All right, so we've got example number 1, a very simple example, right, for a single product. So here is what the question says. Example number 1, The total manufacturing cost per unit, 35.5. The budgeted production and sales, 135,000 units. Right, fixed manufacturing costs, 2,092,500. And then the selling price per unit, which is an amount of 50 Rand. Right, calculate the break-even point in Rand. So that is what we want to do. We want to give a memo for example number 1. Right, so the first thing that we need to calculate here, right, we need to calculate break-even, right, in terms of the units, which is our total fixed costs. Right, and then all of that divided by the contribution per unit. Right, then we'll be able to get our figures there. Right, so we know the formula says total fixed costs. Right, the question is, are we given the total fixed costs divided by the contribution per unit? So when we go to the question, the total budgeted fixed manufacturing cost, we are given the fixed manufacturing cost. Right, please remember, we don't always limit ourselves to manufacturing cost. Right, you add all the total fixed manufacturing, all the total fixed costs that you have, both manufacturing and non-manufacturing. But in this example, we're only given fixed manufacturing costs, so we just use that. But in practice, all the fixed costs that you have, right, as an entity, you add them together to get your total. Right, once we have that, then we need to divide that by contribution per unit. Right, however, if you go to the question, the contribution per unit is not given. Right, but we have been given the total manufacturing cost per unit. Now, when we say total manufacturing cost, it is made up of the variable cost and the fixed cost combined. That's why it is your total manufacturing cost. So included in there is that fixed manufacturing cost that we have been given. So we need to find out the variable cost there. We need to find out the variable cost. So remember, we've been given the total manufacturing cost per unit. So what we can do, we can calculate, right, the total manufacturing. Right, so we can calculate the total manufacturing costs. Right, is 35.5. Right, per unit multiplied by 135,000 units being produced. Right, so what it gives you here is your total manufacturing cost in total. So which means as an entity, we've got 4792,500 in total. Right, then we say if we now less the total fixed manufacturing cost, which is given, right, which is that total of 2092,500. Right, then it simply means the balance of that total should be the variable cost incurred for the year. Right, so therefore we have a total of 2.700,000. So that's our total variable manufacturing costs. Right, are we on the same page, good people? Are we clear? Right, then we need to calculate contribution per unit. Right, when we're given the selling price is given. So therefore, to calculate the contribution per unit, we will use our formula. And the formula, since we are already given contribution sales price per unit, we say selling price, which happens to be 50 Rand. And then we say less the variable cost per unit. Right, we have a total of 2700 in variable cost, but remember this comes from 135,000 units. Right, so if 135 gives me 2.7. So if you say 2700 divided by 135, right, it simple means that per unit we are having 20 rand, which means at the end of the day, we are looking at 30 rand, which is our contribution. Right, so this is our contribution per unit. As long as you have got the contribution per unit and the total, you are done here. Right, then you can get the number of units that you need to break even. Right, in which case it will give you 69,750 units. So those are the number of units that you need to break even as an entity. Right, it doesn't mean that the entity will produce 69,750 units, right? It's just a measure that will help them to be able to decide on a productive number of units to produce. You don't want to produce anything below 69, you make a loss. You don't want to produce anything above 69, but very close to 69, the profit will be small. You need to produce more than the 69,750 to make more profits. And the further away from the 69 that you actually produce over and above the 69, the higher the amount of profit that you can make. So that's your break-even calculation. Any questions, good people? Right, let's add break-even. Right, in terms of value for this one. Right, we can use our two formulas. We can say, right, break-even units that we already have. Right, we already have our break-even units, and then we can multiply by the selling price. So our break-even units, we already have 69,750. Our selling price is 50,000. Right, we can actually calculate break-even in this way in terms of rand value. Right, in which case we can then get a rand value of 3,487,500. So if we are able to produce at the current setup, we are able to produce and sell, and we have a quantity, a sales value of 3,487,500. We are at break even, right? Or we can use the formula which is most favored, which is basically to say your total fixed cost, right, divided by contribution. This time you divide by the contribution ratio. So you take your 20,92500, which is our total fixed cost, and then you must divide that by the contribution ratio. Right, as for the contribution ratio, right, remember it is your contribution divided by sales. Right, in which case our contribution, we got contribution of 30 divided by the selling price of 50, all of that times 100 over 1, and then we get our contribution ratio. So therefore, we're going to be sitting on 60% here. So therefore, you just divide here by 0.60. 2,092,500 divided by 0.6, that will give you 3,487,500. So this will be your rand value in order to break even. Right, any question, good people? Are we clear?
Yes.
Right, let's go to the margin of safety. Right, if the question asks for the margin of safety, remember it's your expected sales, right, less the break-even sales. Right, so the expected sales in total for this were 135,000 units, and the break-even we said 67,000. We said 67,750. So you subtract that from the expected sales, and then you have your break-even. right, which will give you 67 again, 750. So that will represent, it's 69.
Yes.
All right, so it's 69.
150.
Thank you. Thank you for that. So that's 69, right, which will give us how much then? So 135,000 minus 69.
65.
Okay. Right, that will give us
65.
65. Thank you. That will give us 65, 750 units. If they want the margin of safety ratio, right, it is the margin of safety divided by expected sales. Right, times your 100 over 1. So in this instance, we can then say 65,750 divided by 135,000, right, multiplied by 100 over 1. So 65, let me check something. If we say 135,000 minus 69,750, that should be 250, eh? That should be 250. So that should be 250 as well. Right, so 65,250 divided by 135,000, that should give you roughly 48.33%. Right, so this is what we get in terms of the margin of safety ratio. Right, let's say the entity is going to target profit, right, units to achieve, right, a target profit of 5 million. Right, so that's too big a figure. Let's give a target profit of 1.5 million. Right, so we then say total fixed cost here. Right, you add the target profit. Right, all of that you then divide. Right, we then divide all of that by the contribution per unit. So we say 2092,500, which is our given quantity of fixed costs, plus 1.5 million. Right, all of that then divided by contribution per unit, right, which is our quantity
30 rand.
right, of 30 rand. Right, then we'll be able to get our figure there. So if we say 2092,500 plus 1.5 million, all of that divided by 30, right, then you are going to get 119, right, 750 units. Right, so these are the number of units that we've got to produce and sell, right, if we are to achieve a profit of 1.5 million. So that's an important calculation as management when you are planning your things. Remember, you also have a target for a profit. You should be able to determine using the cost profit volume analysis how many units need to be sold for you to achieve that. So these are your usual calculations, right, when you have cost profit volume analysis. Right, the other calculations that may come maybe to say what would be the profit if we change the selling price to a certain quantity. So that one is very easy, right? If we say it's to change the selling price by a certain amount, let's say, for example, we know that profit is equal to PX, right, minus BX minus A. Right, so if we are to change the price from what it is now, which is 50,000, you just apply the new price on the formula there and you'll be able to determine the new profit figure. Right, it could be a change in price, it could be a change in quantity, it could be a change in any of those variables that we have. So net profit is equal to price multiplied by X minus PX minus A. So if someone says we change the price to 60, it simply means now you say quantity 135,000, right, multiplied by 60, right? 135,000, which is B, multiplied by 60, right? If your variable cost are 60 rand. Here we said the variable cost are how much, by the way? It was 2700 divided by 135,000, right? It was 20 rand. Right? It was 20 rand and then minus 2092,500. Right, so you'll be able to get the net profit figure. If as management you want to review the impact in terms of quantity, right? What you can do on the same formula, if the other things are remaining constant, now you simply change the what? The quantity, and you'll be able to calculate the new profit figure. So that's break even if you are having 1 unit. You can be asked this at this level. They've done that before. However, most of the time at this level, you deal with multiple units or multiple products. Right, so when we have multiple products, it's a bit tricky. Right, this is because in our formula for the calculation of break-even per unit per single product, right, we have to say total fixed cost divided by the contribution per unit. Now, the problem with multiple units is that usually the fixed costs are shared cost between the what? The different products. So it's not easy to isolate the fixed costs per product. Right. For example, if you have got 3 products that you manufacture in a factory, rent expense, which is most likely to be a fixed cost, will be a shared cost between the 3 products. So therefore, you need to find a way of allocating that fixed cost usually to what? To product per unit. So because the fixed costs are usually shared, then the calculation is a bit cumbersome because we cannot easily what? Divide that cost and allocate accurately what goes to each product. Right. However, the calculation can be done in this way. If you have got multiple products and you want the break-even. All right. So if you are looking for the break-even, right, in terms of units, right, it is a very simple calculation. I must add, whenever you get a question, right, which requires you to deal with cost profit volume analysis, a serious student must get 100% of that question. This is one of the easiest topics that you can do, right? But however, remember, there are plenty of formulas here. And there is only one method of memorizing formulas. It is to practice the question. So if you take 2, 3, 4 questions, you practice this, you return the formulas, and then you keep on practicing them regularly as you go along the year. Right, if you don't practice, even if something is easy, and as long as it has got formulas, you tend to forget the formulas. So practice will make you perfect. So here we calculate in steps. Number 1, you must calculate contribution per unit. Right, you need to calculate contribution per unit. Right, then you need to calculate, right, weighted contribution. Right, then you need to calculate break-even in total units. Right, break-even in total, right, all type of products. Right, so all your products combined, we are saying what is the total number of units that you need across your different products. Right, then finally, you then allocate break-even units, right, to each product type. Right, so this is what we do if we've got multiple products. All right, there are many different methods of calculating this. I'll only teach one so that we don't have confusion. The one that I think is the easiest and shortest to calculate. Right, but if you go to maybe the study material, you'll see 1 or 2 other methods that are applicable. I'll just teach one here. Right, it says Freud Limited manufactures bicycles and tricycles. The following budgeted information is available for the 20X9 financial year. Right, then from here, we are then given bicycles, we are then given tricycles. Right, so we have the direct material, direct labor, variable manufacturing cost, sales commission, selling price, and the annual demand. The other budgeted cost for the year, fixed manufacturing, fixed selling, and administrative. So what we do here to calculate break-even in our example number 2, it's actually a very simple calculation. Right, so for this one, we are going to say, first things first, what is the contribution, right, per unit? Right, so we know we've got two products. Right, we've got the bicycles. Right, we've got the tricycles. So these are the two products that are there. We need to calculate contribution per each. Right, contribution should be an easy calculation after you have done your cost profit volume analysis. Sorry, your direct and indirect costing. Right, so we have the selling prices per each product, 1.2 and 800. Right, so those are the selling prices. And then we say less our variable costs. So here we don't discriminate on the variable cost. It's all your variable cost, both manufacturing and non-manufacturing. So we did see that we've got direct material, we have got direct labor, right? So the direct material 400, 300. Right, where was I? Okay. Right, so we've got 400 here. Right, we have got 300 there. Right, and then we have the direct labor, 250 and 200. So we have 250, right, and 200. Right, then we have the variable manufacturing overhead costs. Right, on the variable manufacturing overhead, 120 and 80. Right, so we've got 120 and 80 rand. Right, then we have the sales commission. Right, sales commission is a variable cost. Right, remember you are rewarded for each unit that you sell. So therefore we have 60 and 40 there. Why is it taking me back there anyway? All right, we have 60 and then we have 40. So now we have our total variable cost per unit. We now add and get our total figures there. Right, so if we say 400 plus 250 plus 120 plus 60, we are going to get 830. From the 1.2, we are looking at 370. So that's our contribution per unit. Right, 300 plus 200 plus 80 plus 40, we are sitting on 620. Right, from 800, we are sitting on 180. So those are the contributions per unit. That's your step number 1. Step number 2, contribution or weighted contribution. Right, so what you need to do, you have got your bicycle. Right, you have got your tricycle. Right, you need to find what is called the sales mix. You need to determine what you call your sales mix. Right. Please hold on, please hold on. Right, so what you do, you go to your question, you then determine, according to your sales plan, how many units of each product is planned for sales. So we've got annual demand 15 and 18. So therefore, we are saying as our plan as an entity, we have planned to sell 15,000 units here and 18,000 units there. Right, which basically then give you a total of how much. So you add two. So that would be 33,000. Right, then to get the weight, you say 15 over 33, right, 18 over 33, then you get your percentage. So if you say 15 divided by 33, right, so that's 15 divided by 33, I get 0.45, right, which means the other side has got 0.55. Then we multiply by each product's contribution per unit, and then we sum up the two, we get the weight. So 0.45 multiplied by 370, you are going to get 166.50. 0.55 by 180, you are going to get 99. Right, then you combine everything together to get your weighted contribution. Right. Right, so we are saying 99 plus 166.5, which gives you 265, right, 0.50. Right, once you have that, then you can calculate break-even, right, in total. You can calculate the break-even in total by saying total fixed costs. Right, then you divide by the weighted contribution. Right, then you divide by the weighted contribution. So our total fixed cost, we were given two types, we add them together. So there's the fixed manufacturing and the fixed selling. 580 by 320. Right, then all of that, you then divide by your figure there, which is 265.50, and then you get your quantity. So 580,000 plus 320,000 divided by 265.5. So that will give you 3389.83. Right? We always round upwards. So this will be 3390. Even if you had 0.1, you still round this way. We don't round the way that we do in mathematics. We always round upwards and never downwards. Even if you have got 0.005, you will say 33 point or 3390. Right, then if you want the break-even, right, units per product type, right, if you want the break-even units per product type, this is what you do. So you'll have your bicycle, you'll have your tricycle, right, then you'll get that value. You will multiply by the weightings, the sales mix ratio. Right, this is your sales mix ratio. So you simply take your break-even total and multiply by the sales mix ratio. This one should be 553. Right, then you can have your value. So if you say 3390 times 0.45, so you always round upwards here. So that would be 26 if you round upwards. Right, 390 times 0.55, that would be 1865. Always make sure that you round upwards. And you'll be done with the calculation of break-even if you have got multiple units. Any questions, good people from the floor? Right, are we clear?
Yes.
All right,
Sorry, sir.
yes, ma'am. Mhm.
I wanted to ask you about that sales mix unit
The sales mix ratio.
ratio. Yeah, I didn't understand it very well.
All right, so that one is simple. Remember, they will tell you how much the budget is in terms of sales quantity per each unit. So you use the sales quantity. So here they gave us sales demand. So they just said annual demand. This is 15,000 units. This is 18,000 units. So this is what we have planned to sell per each product. So when we say the sales mix ratio, you simply say 15, right? You say for the first product 15, and for the other what? 18,000, you add them. And then you
Okay.
determine the ratio of each by simply saying 15 over 33, 18 over what? 33, you will be able to get 0.45. So this is how our sales is mixed in the ratio of 0.45 for product B and 0.65 for what? For product T. So every time that we sell, we are planning to maintain that sales mix. So this is the sales mix now that we then use to determine the weighted contribution.
Okay.
Are we there?
Yes.
Sharp. Right. So what you do, you go to your questions, you look for a question with cost profit volume analysis. It means if you are doing CTA, you go to one of your test one questions from maybe last year or the year before. You have got toilet, I think it's 105, if I'm not wrong, for CTA. If you go there, there is a list of tests. So you look for test number one, you find one question with cost profit volume analysis. Now you attempt it. Right. In our class next week, I'll bring a slightly more complicated example from one of these tests or from one of the assignments for the CT1. And then we cover that and we'll be done with cost profit volume analysis. But I'm sure you can see cost profit volume analysis is a very friendly topic, very popular for that matter. You need to maximize, please, on this one. No mistakes. Right. Our CT need 10 minutes break. Or let's make it up to 10 minutes. And then when we continue, we'll make it up to 9:40 or 9:50. Right, up to 9:50. When we start, we're going to do process costing. Thank you.
Okay, sir.